Chapter 1. The Concept of Skin in the Game. Skin in the game, SITG, is a term coined by famous investor Warren Buffett, referring to a situation in which high-ranking insiders use their own money to buy stock in the company they're running or helping grow. Theoretically, putting skin in the game makes certain that people who run a company have a direct interest in running the company well. In the majority of my completed for skin in the game senior management searches, the majority have consistently performed well and have reaped their monetary rewards at the liquidity event, company exit. When management owns stock in a company, they want their company to perform at a high level to generate returns and will put forth a consistent effort to accomplish or exceed company earnings before interest, taxes, depreciation, and amortization, EBITDA, goals. Having skin in the game is different from having performance-based bonuses and other types of compensation because there will be direct consequences to management if the value of the company's equity drops. Skin in the game management will definitely lose money if their company loses money. On the Private Equity Capital Growth Council's website, watch Private Equity Minute, a 6-part video series featuring Dartmouth College's Tuck School of Business professor Colin Blayton. The series is a primer on the private equity model and how value is created for private equity-backed companies. Check out privateequity@work.com/what-is-private-equity/. What's involved? Chief Executive Officer, CEO hires would typically invest $100K of their own funds in exchange for typically a double-digit percentage of company equity, depending on the market capitalization. Vice presidents, VPs, would invest $60K to $100K for a single-digit percentage of the company. Generally, all hires made soon after the portfolio company has been acquired by the private equity firm are given the strike price per share, which is the same price per share as the original private equity ownership. Some hired candidates have asked for and been allowed to purchase more shares. Vesting is typically 20% per annum. Full vesting takes 5 years or at the sale of the company. Stock option plans often require the company attaining annual goals and objectives to be earned individually for each year. Normally, companies are held by the ownership for 4 to 5 years, but up to 7 years or more before they are sold either to a financial buyer or strategic buyer. If you end up joining a portfolio company as a skin-in-the-game hire a few years after it has been acquired, you may incur tax obligations due before the company is sold to another ownership. Often, our private equity group G client will loan our hired candidate the money to pay such taxes and deduct it from the hired candidate's future bonus earnings or at the liquidity event. I always advise my skin-in-the-game candidates to discuss their job offer letters with appropriate legal and tax advisors before making their decision. See accompanying PDF for examples of several C-level hires whose investments generated multi-million-dollar returns. Pros and cons. Do you enjoy being in a risk-reward situation? What does it mean for you to be a peer equity owner in a company you are helping to grow versus being just an employee? Do you have any money to invest in a skin-in-the-game job opportunity at the title you are seeking with a middle-market portfolio company? I have been involved in senior manager hires involving as little as $20K hired candidate investment. Sometimes a client will offer earned stock options with no out-of-pocket expense to the hiree. If you are presenting yourself as a CEO, Chief Financial Officer, CFO, or Vice President, VP, seeking a signing bonus, maximum starting salary, automatic raises and bonuses, perks, and 4 weeks vacation, odds are the private equity owners of the portfolio company you're considering won't be interested if you can't put skin in the game. Forewarned is forearmed. Investing your own money in portfolio company equity depends on your own interpretation of your due diligence research. Consider the confidential description memorandum of the private equity firm's acquisition of the company and their financials, and the private equity firm's strategy going forward to grow the company's EBITDA towards a successful exit plan. How much challenge do you want in your employment situation? You have to conduct your own